Every single tax season, millions of Americans face the exact same high-stakes question. Get it wrong in one direction, and you could be staring down some incredibly steep IRS penalties. Get it wrong in the other direction, and you might just be walking away from a substantial refund that is legally yours.
And that brings us directly to our central question: do I actually need to file a tax return this year? The answer isn't always obvious, but it is entirely knowable. Today, we are bringing absolute clarity to the 2025 federal filing requirements so you know exactly where you stand. We are not going to rush this today. Our roadmap covers 1. The gross income starting point, 2. Single filer tax thresholds, 3. Married filer tax thresholds, 4. Head of household and beyond, 5. Quick reference threshold summary, and finally, 6. 3 crucial filing exceptions. Every single status will be covered, so you can just sit back and map your exact situation to the rules.
Section 1. The gross income starting point. Before we look at your age or your marital status, the IRS looks at one very specific, unyielding metric to make their decision. And that metric is gross income. Gross income is absolutely everything you earned during the year before any deductions, before taxes, and before expenses are taken out. We're talking about wages from your W-2, cash tips, any freelance payments, rental property income, and investment income. It's the whole shebang. All of it counts. So what that means is you cannot simply look at your final take-home pay or the amount that hits your checking account to determine if you need to file. You have to look at that big top-line number. Even a small amount of unexpected gig work or interest from a high-yield savings account adds up and contributes to this top-line total. The IRS sets a minimum threshold for each filing status based purely on this gross number. If your gross income is below your specific threshold, you're generally not required to file. If you are above it, you absolutely must file. For 2025, these thresholds perfectly mirror the standard deduction amounts.
Section 2. Single filer tax thresholds.
We're going to start with the most common baseline, which is the standard deduction for single individuals. The exact threshold for a single filer under the age of 65 is $15,750.
Let's ground this in reality. Take a look at Sarah. She works part-time, is single, under 65, and earns $14,000 for the year. Here's where most people get confused about this one. They think because taxes were automatically withheld from Sarah's paychecks by her employer, she is legally required to file a return to report it to the IRS. But because her $14,000 in gross income sits firmly below the $15,750 threshold, she is absolutely not required to file. The IRS does not demand a return from her. So what that means is, strictly speaking, she is completely in the clear. However, and this is a massive distinction we'll explore later, she might actively want to file anyway to get those withholdings back in her pocket as a refund. But from a strict legal requirement standpoint, she doesn't have to. Now, if you are a senior, the rules actually shift a bit in your favor. Seniors get an additional $2,000 on top of the base deduction, so the threshold for single filers age 65 or older bumps up to exactly $17,750. Let's look at Robert. Robert is 67. He's retired, and he brings in $16,500 from doing some part-time consulting work. Here's where most people get confused about this one. They assume retirement automatically exempts them from the tax system entirely. Or conversely, they worry that any active working income at that older age means they suddenly must file no matter what. But the math is entirely objective here. Robert is a single filer over 65, making $16,500. So what that means is, the IRS really doesn't care whether that money came from a standard W-2 job or independent consulting for this specific threshold test. Because his earnings are safely underneath his $17,750 limit, he is not required to file a federal return. Simple as that. Section 3. Married filer tax thresholds. We are now going to see a really significant jump in the dollar amounts as we look at joint households. For couples married filing jointly, where both spouses are under 65, the 2025 combined threshold is exactly $31,500. Let's apply this directly to Mike and Lisa. They are in their 40s, Mike earns $18,000, and Lisa earns $12,000. Here's where most people get confused about this one. They try to apply the single limits to their individual incomes separately, panicking because Mike's $18,000 is over that single limit we talked about earlier. But for joint filers, the IRS requires you to add absolutely everything together into one pool.
So what that means is you are taking two potentially wildly different incomes and dumping them into a single household bucket to test against that joint limit. When we combine Mike and Reese's earnings, their total gross household income is $30,000. Because that $30,000 is below the $31,500 joint threshold, neither of them are legally required to file a return. Age plays a huge factor for married couples too. Let's break this down into two distinct scenarios. First, if just one spouse is 65 or older, the threshold rises to exactly $33,100. Then, if both spouses are 65 or older, each spouse gets a boost, so the limit jumps to $34,700. Let's look at George and Martha. George is 68, drawing a $20,000 pension. Martha is 70, making $13,000 from W-2 wages. Here's where most people get confused about this one. They mix up taxable income sources, assuming a pension is categorized differently than wages when establishing their baseline requirement, or they think both partners need to be seniors to get any sort of bump. But combining George's pension and Martha's wages gives them a total gross income of $33,000. So what that means is, because they are both over 65, their limit is that highest $34,700 mark. Since their combined $33,000 is below that limit, neither of them are required to file.
Now, let's look at the alternative for married couples. Married filing separately. The threshold here is, wait, I literally have to double check this every time. $5. Just $5. No way! It is not a typo. If you are married but filing a separate return from your spouse, you must file if your gross income is exactly $5 or more. Here's where most people get confused about this one. They assume the standard deduction still protects a basic level of income for everyone, regardless of their specific filing status. It entirely does not. So what that means is, the IRS heavily restricts the married filing separately status to prevent couples from exploiting tax loopholes, like improperly shifting deductions or hiding income between spouses. If you earn enough to buy a single cheap cup of coffee, the IRS legally requires you to file a return. It's wild.
Section 4. Head of Household and Beyond. Let's pivot to the more complex family filing statuses, starting with a very common one. The exact threshold for head of household under 65 is $23,625. To claim this, you must meet strict criteria. You must be unmarried, you must have paid more than half the cost of keeping up a home for the year, and you must have a qualifying person, usually a dependent child, living with you. This brilliantly illustrates our next scenario with Maria. She's a single mother, under 65, raising one child, and she earned $22,000 during the year. Here's where most people get confused about this one. They assume having a dependent means they automatically have to file to prove that dependent exists to the government. But looking strictly at the law, Maria's $22,000 gross income is below the $23,625 threshold for her status. She is not required to file. So what that means is, strictly speaking, she is below the mandate. However, Maria absolutely should file anyway. Because of her income level and her dependent, she is likely leaving major tax credits on the table, like the child tax credit, if she ignores the filing process. There are a few more specific statuses here that we need to unpack deliberately. For an older head of household, aged 65 or up, the exact limit is $25,625. Then we have the qualifying surviving spouse status. This applies if your spouse passed away in the prior 2 years and you have a dependent child. The exact threshold there is $31,500 if you are under 65 and $33,100 if you are 65 or older. Here's where most people get confused about this one. They don't realize these special categories exist to give widows and widowers the exact same high thresholds as married couples for a limited time. So what that means is, the tax code builds in a vital 2-year financial grace period, allowing a grieving spouse to maintain the higher joint filing threshold while they navigate a major difficult life transition.
Section 5. Quick Reference Threshold Summary. Let's take a collective breath here. We have covered a lot of ground, so it is time to consolidate everything we have discussed into a single clear view. I want you to read these out with me or just listen closely as I run through this definitive 2025 summary table. For single under 65, the exact limit is $15,750. Single 65 or older, $17,750. Married filing jointly, both under 65, $31,500. Married filing jointly, one spouse 65 or older, $33,100. Married filing jointly, both 65 or older, $34,700. Married filing separately, just $5. Head of household under 65, $23,625. Head of household 65 or older, $25,625. Qualifying surviving spouse under 65, $31,500. And finally,
Qualifying surviving spouse 65 or older, $33,100.
Section 6. 3 crucial filing exceptions. Now we need to shift the narrative. Everything we just discussed has a massive caveat. There are 3 situations that completely override all the income thresholds we just spent time learning. First, if you had self-employment income of exactly $400 or more, you must file. No exceptions. Second, if you received advance premium tax credits through the health insurance marketplace, you must file. The IRS requires a return to reconcile what they advanced you against what you actually earned. Third, if you owe any special taxes, like an early withdrawal penalty for taking money out of a retirement account before age 59 and a half, you must file. So what that means is, even if your total gross income was only $3,000 for the entire year, but you earned $500 of that from driving for a rideshare app or doing freelance graphic design, you have triggered exception number 1. You are legally required to file a return, period.
The absolute crucial point of all of this is summarized beautifully by this quote right here. Being below the threshold means filing is not required. It does not mean filing is a bad idea. Getting a refund is vital if you had taxes withheld from your paychecks, or if you qualify for refundable credits like the Earned Income Tax Credit, just like our earlier example with Maria. Filing when not required is the only way to put that money straight back into your pocket where it belongs. We are going to dive deep into how to maximize those exact refunds in the 3rd explainer of this series. But next up is explainer number 2, where we will thoroughly unpack that $400 self-employment rule. If you earned any money from freelancing, gig work, or a side hustle in 2025, that 2nd explainer is absolutely essential. Subscribe so it's there when you're ready, and I'll see you in the next one.